And joining me on the call today is Trey, Talley, the head portfolio manager for Fluent Financial. This webinar is going to be a little shorter than the January one. We got some more information about what's going on in the markets and what we're doing with the portfolios. We see kind of a common theme that we've done in the last year with international being a preferred asset class. We see some parallels with what happened in the aughts when being heavily invested in the U.S. markets didn't pay off as well. And we'll talk in more detail about that. So I'll go ahead and get started here. This is information that Fluent Financial, myself, and Trey are provided. It's not private client services. And with that, I'm going to turn this over to Trey.
Thanks, Mitch. Hello, everyone. So the chart you're looking at is just kind of 1 year performance. You'll see a number of different indices there. And really kind of what we've been preaching since the fourth quarter of last year is be diversified. International markets should continue to do well. And that's certainly the case. Blue line there's the emerging markets, up almost 48% over a 1 year period. In contrast that with the S&P 500 right there, kind of in the middle, it's about 14.5% there. So clearly a large performance gap there, one that we are aligned with and very happy about that. But we're going to talk this month about kind of what's going on in the economy. We've had a good jobs report to start the year. Q1 GDP is tracking around 4%. And inflation is hovering, just below that 2.5%. So the economy is looking pretty good. And certainly there's a lot of fiscal spending coming through from the big, beautiful bill. But the year is not done yet, and certainly a lot can change there. Talk about what's going on in markets, because it seems like every day somebody is getting hit and being attacked by this AI wave. We'll talk about what's going on in the Fed and interest rates there. So with that, we'll kind of dive into the first couple of slides here.
Yep. And Trey, the first one we're going to look at is the leading economic indicator index. And this is one that we've been talking about predicting a recession. And I see kind of this blue line peaking above the red line. What does that mean?
Yeah, so this chart here, the blue line there is the 6-month rate of change on this leading economic index, and red line's kind of their arbitrary recession signal. As you can see, we spent a number of years below that signal, but we never did get a recession. It's kind of like, certain parts of the economy did go through their own recession, but it just never became broad. At least not to this date. So right now we're still contracting on this kind of 6-month rate of change, but we are above the kind of warning signals, the recessionary signals there. Gotten a little bit of an acceleration coming out of last year. So that'll kind of be what we are watching through this year. Is can we accelerate? Can we get back into some growth in some of the cyclical parts of the economy and stave off that recession? That's kind of at times, it's been at our doorstep, and so that's what we'll be watching for the balance of the year.
And if we dive a little deeper into the LEI index, I think what's interesting, Trey, is that the financial components have been somewhat positive for both December 25 and 6 months ending in December. Items to the right of the vertical line is positive for the index. Items to the left are negative. So obviously the market has been strong, the credit market's good. Why don't you talk a little bit about the non-financial components?
Yeah, so the non-financial is kind of what we were just talking about, which that's where the pockets of weakness have been in the economy. And post-COVID, they were dealing with a lot of input costs that were climbing higher because of inflation. And then the Fed came in and started raising interest rates, which of course brings up the cost of capital for companies. So places like manufacturing and housing and transportation were all hit very hard, still having a tough go at it. They keep trying to get off the floor there, but they can't quite find that sustained lift. And so, that's kind of what we want to see through this year is, if we're going to stave off this recession, we need these cyclical portions of the economy to start to improve. So far, they're not yet. As you can see, most of those metrics are in negative territory. New orders, business conditions. We've started to see some stabilization in housing, which is good. Housing prices are leveling off, kind of improving affordability. And the jobs market, it's still kind of weak and getting weaker, but we have not seen just this material fall off. It's kind of a low hiring, low firing phase. And so that's kind of what it looks like on a disaggregated view. And we'll take a look this time next month, and we'll see if there was any improvements.
And we actually had a good jobs report last week, and inflation actually ticked down a tad, which was unexpected. Again, that's one data point, 1 month. We don't know if that's a trend. We'll find out next month if it is. Our portfolios have actually held up really well. And what strikes me on this chart, Trey, is NASDAQ is down almost 3% for the year. The S&P is basically flat. And we'll talk more details about the components of what has happened. But what you've been talking about for months is coming true. And fortunately, our portfolios have avoided that. So kind of expand upon what you're seeing.
Yeah, so the themes coming out of last year that really kind of started to dominate in October, where we needed to take a look at kind of your small and mid cap companies. Last year was a good year for international markets and emerging markets, particularly, and we did think that would extend into this year, and so that's kind of what we've seen this year. Is you're starting to see emerging markets up over 10% year to date, and developed international over 7.5% there. And like Mitch was just saying, U.S. markets are basically flat. Investors haven't made really any money all year, and they've certainly been dealt some volatility though. So it's kind of been a bad hand for them. But that's really because the story of index concentration, the Titans, they have been floating the indices up on the year. We'll talk later about how much they've suffered over the past few months, and that's weighing on indices. But the good news is there's just so many stocks out there that were not tied up in that kind of magnificent seven, and so you've seen some good performance. We refer to it as breadth expansion, and that's a healthy sign for the market. So things like the Russell 2000 up over 6%, and the equal weight S&P 500, where everybody gets a slice of the pie equally, that's up over 5% with a flat S&P 500. So those are notable and healthy things that are going on in the markets. Those are kind of what we started aligning to last year, and have made fully the shift kind of before the calendar year turned over. It's what we wanted to see. Those were the themes that we thought would come to fruition, and so far so good for that. So we're really fortunate to kind of catch those big waves, and they are big waves that are historic, and we'll show some slides later on that do prove that.
Yeah, and I think where that's tied into our portfolios, you can see the performance down here. ADV and ADVP have 5 large indices. Historically, we've invested in the S&P 500 and NASDAQ as the top holdings of the 5 indices. Well, those are the bottom 2, and the top 2 are international and small cap. So that's why these portfolios have done well, and we expect them to continue to do well, because the metrics concerning international still look positive today and probably will be. And we talked last month about the rotation, where the S&P 500 basically returned less than 1% for 10 years in the odds. And if you were not in international small cap value and REITs, you didn't make any money at all in the odds. So it may not be like that going forward, but we are seeing a rotation in the small caps and international. Now, what's driving a lot of with the markets is what's going to go on with interest rates. And what we have here on this chart, we're looking at possibly 2 rate cuts this year based on data now. This chart changes daily. So when we frame this chart, this is in basis points. So right now we're at 3.5 to 3.75, about a 50% chance of a rate cut in June, and then another one in September, if all things stay equal and the same. And we all know that's not going to happen. If we have some geopolitical event or the economic conditions get worse, you're going to see the Fed cut rates much more quickly. 3% is kind of the magic number they'd like to probably have the rate set up at, and that will bring down borrowing costs, which is going to be incredibly beneficial for the housing market and other areas that have to borrow money. It's also going to help reduce the interest we have to pay on our debts. We'll be paying less on our treasury debt. That's huge. So it's a positive sign. So we're almost reaching a Goldilocks scenario. And Trey, if you want to talk about this next slide, this is the inflation side. There's some kind of good news here.
Yeah, so this slide here, the white line, you're looking at just kind of the consumer price index, so the inflation year over year, and right now we're running at 2.4%. We kind of split that between services and goods, and services is a lot of housing cost inputs. And so those have been coming down nice and slow. And certainly 2.5% sounds a lot better than, 9% like we were reeling with a couple of years ago. The problem we got into in last year was, obviously tariff-induced price adjustments. And you'll see that in the purple bars there, which, your goods component of the CPI inputs really started to move higher, and that boosted inflation back up to 3% in the last half of the year. And that is kind of why the Fed went on pause for their interest rate cuts. So the good news since then is we have seen a turnover back in inflation. 2.4% is pretty good. It's still above 2%, which is where the Fed wants it. But the trends that are allowing us this progress on our inflation are pretty deeply embedded. We're not seeing wage growth take off. We're not seeing housing prices take off. Commodities are still pretty tame. So the outlook for inflation looks really good for the balance of the year. So the Fed can cut and ease some of the pressure on the economy, and they can do that without having to set off another wave of inflation.
Yeah, this next chart goes a little deeper into that, and you look at kind of the swap market, what the expectations are for inflation for the next year up to 10 years.
Right. So these market-based expectations of inflation, this is how traders price in forward inflation. They're making bets on what is inflation going to be, 1 to 10 years out. And so you see kind of the lines there, coming out of the summer of 2025, we really started to nosedive there on the outlook for inflation. Tariffs really just were not the boogeyman that a lot of people thought. Companies had front run a lot of their inventory. Consumers made substitutions. And so we just did not see the big boost that everyone was worried about. It was enough to lift inflation a little bit. And then kind of after Christmas there last year, we really started, inflation started to kind of move up a little bit, about 2.2% up to maybe 2.6% for most time frames. And good news is, once we got out of January, this was all kind of gas related. Gasoline, hit a multi-year low and kind of just rebounded there. And so now gasoline prices have kind of, leveled out a little bit, and all the good news that was still, helping inflation come down is still true today. So now we're looking at about 2.4% inflation forward, pretty much on every time frame. So kind of right where we're at today. And certainly if we can get some help from commodities, then we'll be back at the Fed's target in no time.
Yeah, this next chart is really interesting because it's showing inflation by regions of the country. And red indicates higher inflation, which are the coast and the Northeast, with the exception of New England. And the lowest inflation is here in Texas and in the south central part of the country. And this is really interesting. A lot of it has to do with the higher taxes and just inefficiencies of these states that's costing people a lot more money. So any other information on this, Trey, that we ought to tell people about?
Yeah, no, I think it's just important that, different people in this country are experiencing different levels of inflation. And that not only impacts their budgets, but it probably impacts, their day-to-day lives and how they vote and how they feel. And certainly we can see, in some of these larger cities that inflation is higher than it is in the rest of the economy. And maybe that's, fueling this narrative around affordability crisis that people are feeling. So I think it's good, anecdotes to kind of maybe help tie together some of the economics with, the everyday stuff that we all feel.
Yep. And the next chart is it's disturbing, where it looks like people are spending more money and not saving as much.
Yeah, so this chart's titled Going in the Wrong Direction. And what you're looking at here is just personal savings. On the left, you see it just kind of as a percentage of income. And on the right, you can kind of see just the total level of savings. And so what this is illustrating is that, just consumers are saving less, which the counterfactual is that they're spending more. And that's kind of really how the consumer was able to remain resilient last year. When we think of still, some inflation pressures that are with us, certainly rates are a little higher than what they were pre-COVID era. And then we had tariffs come along and raise prices that consumers had to deal with. And so how were they able to kind of balance all that? Well, the answer is that they just spent some of their savings. And, the personal savings, savings just as a whole is kind of a zero sum, where people like to have a general buffer in case the unexpected happens. And so, for consumers last year who were, tapping into their savings account, whether they were going on vacation, doing, big equipment purchases, whatever, eventually they will want to refill those coffers and they will try and go and build back their savings. Well, if they're not saving, or excuse me, if they are starting to save in the future, well, then they're not going to be spending as much. So this year is what we kind of want to look at is consumer has been really resilient, but we know they had to spend their savings to be resilient. Is that going to continue to be the case in 26? Because if not, it will weigh on growth. And so that's what we want to pay attention to from here.
Yeah, and another point that it's not part of this chart, but it's related. The consumer confidence, like the Michigan Consumer Confidence Index, is low, and a lot of this country is very disappointed and very upset. It may be because of the politics. We have a very polarized nation, but people may complain, say things are horrible. The end is near. Then they say, "Where are we going to go out to eat for dinner?" So they tell people that things are horrible, but they go out and continue to spend money. We talked about that last month a little bit with the consumption part, because 2/3 to 70% of our GDP is what we spend as consumers. If we quit spending money, that could put us into a slowdown or even worse, a recession. So this is trending the wrong way, but this is for everybody. And again, 20% of the top income earners and asset holders really drive our economy. And during the Great Recession of 2008 and 2009, that particular group of people got hit hard. And I know here in Addison, where we're based, we went out for lunch and it was like a ghost town. It was like COVID. We don't see that here now. It's pretty busy here in Dallas if you want to go out to eat. Trey, AI has gotten a lot of press. And let's talk a little bit about this, the kind of the sell-off that we've had in some of these sectors over the past 6 months.
Yeah, sell first and ask questions later. That's certainly been the behavior of investors over the past few months. And the sell-offs that we are seeing are kind of controlled demolitions, it seems like, in the market. And sometimes, it just seems random. And then day after day, you might have a 4-day stretch where some industry has just gotten absolutely clobbered. And so this is, revolving around the innovations and the new iterations of the AI models that are being introduced. And the latest iterations, some of them are very capable and very easy to reproduce some of the software, some of these publicly traded software companies. And so, kind of fourth quarter last year, you saw really the initiation of this, which was, because you see on the timeline there, around September 30th of last year, front office software. So software stocks really started to get hit. As a sector, they were down 11% in a day. And that was, again, new iterations of chatbots and different AI models that were able to replicate some of these companies. And some of these companies were very highly valued. And that's a concern when some investors start to say, is this company going to be viable in the next 5 years? And there's just so much that's happening so fast that nobody's really sure what the future is going to look like in 5 years with regard to AI. And so investors are selling first, asking later. You see, as we rolled into the new year, it just kept continuing. And it seems like it really picked up pace. Gaming, legal tech, insurance brokers, wealth managers, property managers, not even the logistics companies were saved from this. There were a number of different stories, a number of different AI models that were released, all kind of targeting different industries and saying, you're paying for overpriced software. Don't worry, we've got an AI model that can do it for you better. And so these sectors all in one day were getting hit anywhere from 8 to 19%. This was happening very fast. And it started kind of setting off this concern that we don't really know where it's going to set off next. And so it's just raised the levels of angst for investors. We'll talk a little bit more about software later on and stuff like that. The reality is that AI is going to be a very big, important part of the future. Some people are too worried about it, and some people are not worried enough about it. There are companies that will lose, validity, and they will become obsolete. It will be very hard to pick winners and losers at this juncture. And so just be cautious if you're trying to go in there and just blanket buy these because, hey, buy the dip, these stocks were down. Just be careful. And we'll talk about maybe some opportunities that we think are arising in some of these that have been disparately hit and they shouldn't have been.
Yeah, and another takeaway from this slide should be that your children or your grandchildren who are going to college or in college, make sure they get a degree that AI won't replace them or make them obsolete. A great example is if you were a computer coder and that's what you got your degree in and worked in that industry, AI has basically replaced you in the last, year or two. So look at the degree programs and get something that will withstand the AI storm. So this next slide talks a little bit about debt and the AI world starting to borrow more money. And this is a little bit of a concern, Trey.
All right, so these the bars you're looking at here, just kind of the total issuance, how many corporate bonds are being issued out there in the U.S. there, and you'll see, total issuance is picked up over the past few years. It's gotten above that pre-COVID level. So you're starting to see some of that rollover effect. And then kind of the maroon bars there are kind of the AI companies and the bonds that they're having to issue. And you can see that, while the total issuance has picked up, certainly the AI companies issuing bonds has, and that's really unique because in the past they were able to fund, their capital expenditures and their research on. They were able to fund it through free cash flow, and now they're having to issue bonds for it. That's kind of a problem. It does affect the leverage ratios, and investors aren't used to that. Investors were used to, here's how you're going to build the future. You've got the cash for it, and you got some money for buybacks and dividends. Great, love that. And it's set off a concern for investors because it's very different than what we've seen for some of these tech names. It is starting to push up borrowing costs for some of these names. We've talked about Oracle and alike in the past. So just something we want to be aware of. It's not something that can necessarily take down the economy or anything like that, but it can hurt stock price performance, and it has. And we'll talk about that in a minute.
Yeah, actually right now. And what we see happening, Trey, talked about the Magnificent Seven, the magnificent underperformance.
Yep, exactly. So this chart you're looking at here on the left, it's the S&P 500 is kind of the black line there, and then all the gray lines are just all the Magnificent Seven, the big titans of industry that we all know, and many of us have owned for over a decade at this point. And what's interesting is this year, every single one of them are underperforming the S&P 500, and so to compound that, they're actually on pretty steep drawdowns here. So this data is through February 13th, which is last Friday. But you can see the different drawdowns for a number of these kind of Magnificent Seven names. Apple and NVIDIA faring a little better at 11 to 14% drawdowns. So that's kind of where the stock is today and where their local high was. But some of these are significant drawdowns. You look at like Microsoft and Netflix; those are down over 28 and 43% from their highs. Those are material slowdowns. Generally, you do not see them outside of a recession or a profit recession like we saw in 22 for these names, but that is happening. And I think even more interestingly, you'll see the S&P 500 there at the bottom, highlighted in yellow. It's on a 3% drawdown. So you've got something like Microsoft, which is the second biggest component of the S&P 500, down almost 30%. The S&P 500 is only down 3%. And that's because you've had really great performance from stocks outside of this. So that's areas that we really benefit in as stock pickers, and staying aware of the risks out there is, we can tap into those other companies that are doing well, and we don't have to, stay in that risk. And that's kind of what this chart here is showing as well, which is, we're seeing truly historic beginning to the year in terms of performance for the equal weight S&P 500 versus the cap weight. So that means that the S&P 500, 7 of those titans are really hurting, but the rest of the 493 are doing phenomenal. And you'll see, going back to 1976 there, that's the only other time we've really seen this type of strength in the market. But you'll see that this is the second best on record. All those other lines are just kind of the relative performance of all of those years between 1970s and now. And you'll see that, this has truly been a really strong start, something that we flagged last year. We avoided, we made sure we got out of some of these names or got into the names that we really wanted to be. And so we're benefiting as, kind of this other side of the market is finally getting some love, and we're not getting weighed down by all of that magnificent underperformance. And the next one really kind of hits on the other theme that we have been talking about this year, which is performance will be more evenly distributed around the globe, and international stocks will do well. Same idea on this chart here, where we're seeing what it's looking at as the relative performance of the US stocks versus around the world. And so if that blue line is going down, it means that the world stocks are doing better than the US and vice versa. And you'll see that through the run of this year so far, this is truly a historic year. Global stocks, ex-US, have never had this type of outperformance gap versus the US stocks in history, going back to 1995 anyway, so over 30 years. And that's really important. That's one of the themes that we were flagging last year. We got aligned to it. That's why returns look great this year. And we think it has legs. We think it can continue on. And so again, this is the importance of active management. This is really important to be a diversified investor. If you're in just the 7 names, you're not having a great year. But if you're, a diversified investor, you're fine. You're okay.
Yeah. And what this means is you should plan trips to go overseas while you have good health and spend money to support the international markets and bring your kids and grandkids. Trey and I will go to the stock of the month, and Morningstar looks like it's going down into the abyss, but we like it.
Yeah. So Morningstar, stock of the month. And so this follows up. First stock was Dollar General, then UPS and Archer Daniels, and those are up, somewhere between, 50 to 20 and 10% respectively. Certainly we will have one that won't be great. This is more for, illustrative and informational purposes. But this one is Morningstar, and it's in the sector and industry classified as software. So it has been beat up a lot, and it's down, over 50% off of its 1-year high. And, Morningstar is an independent research and data services company. In early 26, we talked about the weakness that software and software as a service stocks experienced. And, some of that is well-founded. It is hard to pick winners and losers, but from here, we should start to see the cream rise to the top. And Morningstar is a company that, its earnings are at all-time highs. It just reported within the past week, and earnings estimates moved higher after that as well. And the stock is, trading with, a 21% year over year earnings growth, and it's, giving you a earnings yield of about 7%. So that means if the stock goes nowhere and it just trades up with where earnings go over the next year, you'll earn 7%. And the valuations on this thing are dirt cheap. The stock's trading at 14 times forward earnings. That is as cheap as it was in the worst of the great financial crisis. So you can kind of juxtapose those two environments where, there is a lot of warranted concerns right now with software, but is this really like 2008 rolling into 2009 when we thought that the banking system would collapse? I think that that's extrapolation, and I think that this is a time where some of these software stocks, because of behavioral biases, have been sold below their intrinsic value, and that you can take advantage of some of these companies, and you can be greedy when others are fearful. And I certainly you don't apply this to the entire software sector. You do need to be selective. We think Morningstar offers great growth at a very reasonable valuation that we can sleep at night. And the street gets incrementally positive on them, even as investors sell them down. And so we've taken our time. You do not want to catch a falling knife unless you want a lot of stitches. I remind myself of that all the time. And this is an area where you have started to see some stabilization of the stock. And not blindly, but informatively, you can start to maybe take little bets on here, and you can capitalize on other people's fear.
I think what's important is Trey mentioned the other 3 stocks. So Trey and Ian are 3-0. This one is a new one to the team. We'll see how well it does in rotation. All right. So as we kind of wrap up here, we'll talk a little bit about our options portfolios. Advantage Plus, I talked about the rotation into more international. Again, what we want to do with these portfolios is produce cash flow for people instead of an annuity that you're stuck in. It's got horrible tax implications. These portfolios are generating a pretty good income stream. And with stock income, we rotate it out of all the individual stocks. We have some in there. We have ETFs that have both equities as well as bonds. So it has some upside growth potential, but it's producing about 8%. ADV is doing a little bit over 5. So it's doing what we want the portfolios to do. So those guys have done a really, really good job. So with that, we'll open this up for questions. I'll go ahead and stop the recording.